Welcome to CEO Money. I'm Michael Yorba. I have David Weild, Chairman and CEO of Weild Company Incorporated, on our show with me. David, welcome to the show.
Thanks, Michael. Nice to be here.
I'm glad you're here. You've got a lot of work that you do in a lot of different facets, one of which is shows social impact with what you're doing. But before we get into the litany of questions I have for you, give us a well-rounded view of what your company does, Weild Company, and really the passion that got you to start it and take it where it is now.
So we are turning the whole Wall Street model upside down on its head and trying to kind of come square into that part of the market which serves growth companies, small cap growth companies, middle market companies that's been largely abandoned because of some changes to market structure that we've written about quite extensively.
Okay. The passion that got you into it, and tell us what kind of companies that you work with, and give us some feeling for you.
So when I was all the way back in college, I actually fulfilled most of my undergraduate biology requirements with graduate level courses in molecular genetics, and I had a real sort of interest in what was then the very dawn of the life sciences industry. Very quickly after I graduated from college, Genentech went public. I actually met Elmer Swanson years ago, who was the founder of Genentech. It was notable because the stock was priced around $30 a share and opened up at 80, and it kind of really enthralled me that you could finance companies and invest in technologies and then in turn improve quality of life, find cures to cancer, so on and so forth. So I ultimately made my way to Wall Street into an area which most people refer to as the equity capital markets groups of firms, which was responsible for the actual structuring, marketing, distribution, and aftermarket support of IPOs. And so I have had a long history, priced over 1,000 different equity offerings in the public markets, including raising some of the first public capital for Larry Fink of BlackRock, which is now the largest asset manager in the world in the life sciences area. I did a very early deal for Celgene back when the entire company's valuation was only about $100 million. And of course, today it's $60 billion, and many other sort of noteworthy companies over the years.
All right, let's get into what your company does and how you're impacting and turning the entire industry sector you're in on its ear. You're doing a lot of social impact investing, just on the coattails of what you just said. Bring us out in how it is that you're changing the model and what you're doing. How big is the market and how you fit into it?
So let's start with market size. We think it's massive. At least we think we can actually create a business of over 10,000 professionals serving the growth economy in the United States, mostly in the investment banking and private placement arena. We are up to about 65, I think, right now. We just founded this business in August of 2016. All the growth has been word of mouth. When you say turn it on its head or turn it on its ear, essentially the traditional Wall Street model is a geographically centered in a major metropolitan area, typically New York, Chicago offices, San Francisco or Silicon Valley. And it's a high fixed cost model. They're paying people salaries. They've invested in a lot of office space and infrastructure. Here, people have their own offices, cover their own expense. It's a very high payout model. They can work anywhere in the United States. From a human capital standpoint, we're bringing people back in that are highly qualified, that may be a little bit older in some instances, that don't want to retire, to women that have left the business, left Goldman Sachs, had their 3 kids, eminently well qualified, but there's no path back to Wall Street, and they don't want to work 70, 80 hours a week and commute into Manhattan, but they can work from their home and run an M&A process with the best of them. At the same time, there's a myriad of smaller businesses that need scale support. The problem with regulation in this country is that running a small investment bank, it's incredibly complicated. The number of rules are incredibly complicated. It takes the joy out of investment banking. You need a platform to effectively run your compliance, your operations. And at the same time, if you're a small firm, you typically have an amazing amount of business that just flows through your fingers. And so it becomes a very inefficient process. For example, if you have an expertise in life sciences, but a friend comes to you with a consumer products company that's extremely attractive, who do you talk to determine whether or not that consumer product company has merit? And on a bigger, broader network, you can bring that piece of business to somebody that does have an expertise in consumer products, and you can possibly participate in the revenue stream that's going to be created from closing a successful M&A transaction, a successful private placement, public offering, so on and so forth.
I get it, and that network can expand exponentially as you grow forward and more people want to work with you because of the way you structured it. I like the model. I'm a very big believer in the model. Impacting companies and supporting social impact companies. Break that out for me.
Yeah, well, what got me into this business to begin with. This was what people referred to as the God's work of investment banking, putting money into smaller businesses. It's the smaller businesses that really are responsible for all the job formation and innovation in the country. Right. And so whether they're companies that are working on cancer immunotherapy, or they're working on hyperloops and new forms of transportation. They're working on
drones, all kinds of things. I get it.
And just about anything. And they really do. These are the things that create ultimately economic leadership. And one of the things that people don't understand is that we have the lowest rate of startups in this country in 40 years in 2016. I'm just paraphrasing from an op-ed that was written in the Wall Street Journal by the chairman of the House Financial Services Committee, Jeb Hensarling. You're not going to have a future if you're not starting companies, and those companies can't get successfully capitalized and grow into sort of the new wave of Amgens and Celgenes and Microsofts, for that matter.
Well, that's the reason they had the Jobs Act, so we could do this, so it would work out this way. Please, go ahead.
Yeah, well, I mean, so it's, people have refer to me as the father of the Jobs Act. I like to say that it's not the act that I would have written if they'd given me the pen. It's a real introduction. I wrote a series of papers that essentially highlighted the problem, which is we had a massive drop-off in the small initial public offering in this country back in 1997 and 98. It was really completely lost on people because it was during the height of the dot-com bubble, and everybody thought everything was rosy with markets. But if you kind of looked under the covers, you would have noticed that big IPOs were getting done, but small IPOs were not. And for a long time, people thought that it was just a market cycle issue, and that during the dot-com bubble, anybody with an idea on the back of an envelope could raise $100 million. And our view was no, that something really, really much more dramatic had happened. And we were able to present the data in a form that people really got. They saw the drop off. It used to be 80% of all IPOs in sort of 97 were under $50 million in size. And by 1998, 99, it was down to 20%, and it never recovered. And as you can imagine, that at the time represented 400, 500 IPOs a year. So out of a total of, call it 500 or 600. And so what we did was we essentially gutted, the ability of smaller companies to find liquidity, to access greater capital. And we put a big hole in that sort of supply chain of equity capital, that bridge, if you will, to ultimately grow into the S&P 500 company of tomorrow. Right. And so by raising the bar so dramatically, what people really don't understand is we started to deprive every startups of accessing startup capital, because if it's going to be harder and harder to get an exit and get a return on the risk capital that you invest in startups, then by definition, you're going to be less inclined to invest in a startup company.
You just named the mantra of our show, what we do. So I'm on the same page with you. Keep going.
Yeah, so then the work that we had got picked up by down in Washington, and some of it was published through the accounting firm of Grant Thornton, which was a client of mine at the time, and they had distributed it. I never set out to get an act passed in Congress. I think I took one political science course in college, so I didn't know much about how Washington worked. And I all of a sudden was getting requests from congressmen to come in and talk to them. And I think it helped being the former vice chairman of the NASDAQ stock market. And the material that I wrote was, we went through a couple of iterations. I got some great advice from the chief of staff of Senator Crapo, who told me to simplify some of the graphics and the information, which we did. And it became quite obvious and quite compelling to people that we had a problem, that the United States of America had dropped the bottom out of its initial public offering market. And then when you started to benchmark us against, I think it was about 13 other foreign countries, the number of publicly listed companies in the United States on NASDAQ, the New York Stock Exchange, or the American Stock Exchange at that time, American Stock Exchange has since been folded into the New York Stock Exchange, that the number of publicly listed companies actually went from about 9,000, these are operating companies, all the way down to 5,000, and nobody knew it. We were the first ones to point that out. And the question is, how could people not know that? And the answer is because the statistics were being reported with fund statistics, exchange-traded funds. So exchange-traded funds, closed-end funds, real estate investment trusts and things were growing in terms of number, and it gave people this sort of false positive that the number of listed companies was growing, when in point of fact the number of operating companies, which are the ones that are actually, those are the life sciences companies, the tech companies, alternative energy companies, so on, those were the ones that were disappearing from the U.S. public markets.
Talk to me about the path back to be able to grow the smaller companies, which create the biggest employment circles as we go forward and spread it out, create more entrepreneurship in America that has an easier path to capital formation, to move to the next level, to grow to the next level. Talk to me about your thought process for that.
Well, we started kind of with a view, the more I got involved down in Washington, is that I wasn't smart enough to be able to predict the legislative path. But I was smart enough to understand market structure and the kind of the basic toolkit that people needed to be able to provide more capital flows to smaller companies. And so we took a little bit of a shotgun approach. There was a paper that you can search it up on the internet, called A Wake-Up Call for America. And it was there was a series of recommendations in there for both private and public markets, and Congress lifted probably about half the recommendations for each of those markets. So as I like to say, we got a half a loaf in the public markets and a half a loaf in the private markets, and now we've got to do the hard work probably for the next 10 years of making sure that we get a full loaf in both. But what we did was an improvement. It gave birth to crowdfunding. This is the Jobs Act. There was the repeal of the prohibition against general solicitation, which now allows you to generally advertise private placements under Reg D 506C, to get technical. Mm-hmm. And it created a sort of an IPO light format called Regulation A+. I actually was very intimately involved in drafting some of that, going back to when it was still House of Republicans bill 1070, I think, was the number before it got rolled into the Jobs Act. And then we also created a new category of IPO to take down some of the burden on the early reporting side for smaller companies, and it's called an emerging growth company. And now 80% of all IPOs that are done through the full-blown registration statement called an S1, as opposed to a Regulation A+ offering, those those deals are almost inevitably taking advantage of the emerging growth company designation, so they have less reporting burdens, and they can also quietly file, which means that if their deal doesn't get done, there's a lot less likelihood that their competitors, see all their disclosure information. So it's actually very helpful to corporations seeking capital.
Well, since you've got so much background on rulemaking with your career, how do you feel, and I'm going to get a little off track here because normally we're just talking about public equities here, but what about ICO market? I mean, do you see that as becoming actually regulatable to the point where it's a viable means that you're going to see larger investment companies or endowments or pension funds see that as a viable means for an alternative investment, similar to what they're now looking at with Reg A+? I mean, they're accredited investors, but and qualified. But do you see where I'm going with that, with my question?
Yeah, no, absolutely. I mean, I think that people are very excited about tokens, initial coin offerings, and the like. But I don't think that it's as radical as people make it out to be. And the vast majority of these things are going to be securities, and they're going to have to come through securities regulation. If I was just, there are essentially three types. By the way, I'm an advisor to Templum, which was the first alternative trading system that was approved by the SEC to be able to trade tokens as securities. I'm also on the board of directors of an Israeli company called IFX that's got an F1 filed with the Securities and Exchange Commission to be able to trade tokens. There is there are utility tokens which are essentially like giving somebody a token that gives them access to software. It has function to it. That's really not where all the speculative hype has been. There are some tokens that actually have economic value and utility value. And then there is this new emergent area, which is, where we are tokenizing assets, so that instead of having a stock certificate, you can have a token that represents essentially the same thing as the rights of a stock certificate, or a token that gives you the equivalence of a bond and or a smart contract. And so this is this form of stock ownership, if you will, or form of asset ownership, is going to become, I think, increasingly prevalent. And to answer your question, I think that when they solve the custody problem, which is important to institutions, I think you'll see more and more institutional money get allocated to owning various forms of tokens, whether they're tokens as securities or they're blockchain companies that are using the block to keep as a sort of general ledger to keep track of transactions. It's important to logistics, those businesses. But you're going to find that this technology is going to cross the mainstream or the chasm of investment, to paraphrase a well-known book. And it's going to end up becoming widely accepted. You will see cyber wallets get embedded into securities accounts. The big retail broker-dealers are not going to allow assets to flow out of their firms. I'm talking about the Morgan Stanleys, the Bank of America Merrill Lynch's, the UBS's of the world, and Goldman Sachs for that matter, Credit Suisse. You are going to, Wells Fargo, you are going to see that at some point they will allow people to purchase tokens through their traditional securities accounts because it's in their economic interest to do so.
David, I hate to interrupt because you and I could go on, and maybe we should some other time. I've got to call it quits here for today, but I'd love to have you back on the show so we could take these topics we raised today and drill down into them so that the people that are watching get more impact out of some of the detail that they're really hungering for.
I'd love to, Michael, anytime.
All right. Thanks for being a guest on the show.
My pleasure. Take care. Bye-bye.
All right. You've been watching CEO Money with Michael Yorba. Like us on Facebook, follow us on Twitter, and subscribe to our YouTube channel.